Hello, everyone. Welcome back to my channel. I am Carla Dennis, and I am going to be talking to W-2 wage earners and real estate investors today, or people who are thinking about investing in real estate. I want to talk to you about a very powerful strategy that is going to help reduce your tax bill when you own real estate. Like, this is going to be fire. Before we jump in, I need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. Now, let's get after it. When you are a W-2 wage earner, did you know that you can use real estate investing as a write-off against your W-2 wages? This is how a lot of people are able to acquire real estate and continue to get even more real estate because they're lowering their taxes, putting their cash in their pocket, and investing in real estate. And I want you to be able to do that as well. That is why I need to break it all down for you. The first thing that you need to understand is that real estate is considered a passive activity. What does that mean when I say passive activity? A passive activity means mailbox money, means you don't have to do anything to earn that money. It means that money is earning in its sleep because the real estate itself is doing the work for you. But because it's a passive activity, guess what happens? The law states that when you have a passive activity, they limit the amount of your losses that you can take against other income. Currently, real estate is considered a passive activity, which means you can only deduct up to $25,000 in losses against any other income on your tax return. You might be thinking to yourself, well, Carla, why on earth would I have $25,000 in losses? I'm gonna explain that to you in a minute, so put a note next to that. But here's what's really important. If your income is $100,000 and below, you get to take the maximum loss of $25,000. But if your income goes above 100 to 150, you get a scaled back version of the $25,000. If your income goes over 150,000, you're not even getting $25,000. But here's the thing, there's always a strategy that you can utilize. And that strategy is called being a real estate professional. No, I didn't say go out and get your real estate license. That is not what I said. I said being a real estate professional. That's an actual term in the tax code. And what a real estate professional is, a real estate professional is someone that has started a business in real estate. Perhaps you're going to be an investor. So you open up an LLC in real estate. So you started a business in real estate and you're spending at least 50% of your time in your real estate activity. Let me give you a scenario on how that can happen. Let's say I file a joint tax return with my spouse. My spouse works a W-2 job all day. And let's say I manage our real estate portfolio. If I'm managing our real estate portfolio, all of my time is being spent on the real estate portfolio. Therefore, I have my LLC set up, I have my real estate portfolio, or maybe I'm just starting out with one, and I am putting at least 750 hours into managing my real estate. If that's the case, guess what? And you're gonna wanna write this down. You're not limited to the $25,000 in losses. You can take any amount against your W-2 income. But remember I told you we needed to go back to that question, why would you have a loss? I need you to make a note of this. Depreciation. Depreciation is a gold mine when it comes to real estate. Let me explain to you what depreciation is. Depreciation is where you are able to recover your investment in the real estate, get a write-off over time. When you purchase real estate, and let's say we purchase a house and it's $400,000, we got to separate between building and land because we know the land is always going to be there. But the building portion, we can actually depreciate the cost of the building portion. So on that $400,000 home, let's say my land is worth $100,000 or my land is worth $250,000. That means my building allocation is going to be $150,000. What does that mean? That means that I can write off the building portion over time. Right now, if it's residential rental, you can write it off over 27 and a half years. I know that's a long time, but hold on a moment. I know it's a long time, but I told you I was going to tell you about a killer strategy. If you were to do a cost segregation study, you would be able to write off a big chunk of that $150,000 or whatever that building cost basis is against your W-2 income. But let's go back to an example. Let's say that my husband is making $200,000 a year. And let's say we purchased that real estate and my building value is $150,000. And let's say I did a cost segregation study. And out of that study, I'm able to write off $125,000. That means that $200,000 that my husband makes in wages, I'm gonna take a loss against that $200,000 at $125,000. Yes, $125,000 loss. Yes, it's legal. Yes, it's a cost segregation study. And yes, it's the law. His $200,000 is gonna drop down to $75,000 worth of taxable income. You heard me right. Drop down to $75,000 worth of taxable income. Oh, I love this strategy. But wait, there's more. In order to make sure that you qualify to be a real estate professional, we want to make sure that you keep the proper documentation. What's required for you to document? You have to document the cost basis of the property you acquired. When you close escrow on real estate, you're going to get what's called a HUD-1 form. That's the form number that you get from the escrow company or the lawyer's office that breaks down all the costs of the real estate. You need to keep that form. You need to also find out the value of your building portion versus the land portion. Do some research online. Look at the property tax statement. Look at the appraisal. They're going to do an allocation. And you want to take the best allocation you can because you want the most allocated to the building. Once you do that, you're going to also document the time that you spend on your real estate. You need to keep a real estate professional log. What does that look like? A real estate professional log shows the date, shows exactly what you did on that date. I went to the property. I checked on my fire detectors. I went to the property. I checked on my gardener. I went to the property and I mowed my lawn. I painted my fence. I did an inspection. Document, document, document. And you got to document what I like to call feet on the street, the things that you do when you're physically at the property. And you're probably saying, well, wait, Carla, so if I'm managing from afar and I got out-of-state real estate, that doesn't count? When you are doing administrative activities, you got to be careful because you got to have what we call activities that involve your material participation, meaning that you are there, you're checking on things yourself. So if you have out-of-state property, go check your property out. Take a road trip, take a flight, take a bus, a plane, a train. Just get there and make sure you take pictures of yourself there and document, document, document. That is going to be so important because this strategy is going to really help lower your income taxes and reduce your tax bill so you can keep more cash in your pocket, so you can take it and go invest in more real estate, go invest in stock, go invest in whatever you want to invest in. It's your money to put back in your pocket. I want to make sure you understand the tax deductions you can take when you own real estate. Not only do you get the depreciation deduction, but if you have a loan on that property, you're going to be able to deduct your mortgage interest. You're going to be able to deduct your property taxes. You're going to be able to deduct the insurance, the repairs. Now, be clear, make sure repairs get deducted, but improvements get depreciated. That's a different thing. An improvement is something that is going to expand the life of the property for longer than a year. A repair is like I repair the plumbing or I repair the door handle, things of that nature. But If you are actually going to the property, make sure you're taking a deduction of your travel expenses, your auto expenses. All of these things are written off when you own real estate. But make sure you have proper documentation, how you pay for it. Make sure you maintain your receipts on what you paid for, because that's required by the law. When you are offsetting your W-2 wages with your real estate investment, you want to avoid some common mistakes. And one of the mistakes that you want to avoid is making sure that you really are qualified as a real estate professional. If you are working a full-time W-2 job where you have to be there 40 hours a week or 2,080 hours for the year, you would have to be doing 2,081 hours in real estate for you to qualify as a real estate professional. So it typically is not going to work for a person that is single, that has a W-2 job, unless they are a firefighter where they only have to work 10 days or a month, that they have some type of flexibility, perhaps a teacher that has summers off. IRS understands the requirements of all the different jobs. However, if you are self-employed, let's say you have an S corporation business and you're starting your real estate business, then you can determine how much time you're allocating to your S corp, and you can determine how much time you're allocating to your real estate professional business. You could potentially qualify as a real estate professional. At the end of the day, it's a powerful strategy. Make sure you understand it. Make sure you implement it properly. Make sure you document it, and make sure that you have a strategy to reduce your tax bill. Because here's the thing, once you know better, you absolutely have to do better, which is why I want you to comment, like, and subscribe so you don't miss out on any of this wealth building information. Now go get that real estate.